Well, hi, everyone, and thanks for joining us. I'm Ted Billich from Risk Alternatives. I think all of y'all know that. And my colleague, Linda Lenro Lopez, is on as well. As you enter from the waiting room, if you could just put your name and your organization in the chat, that way, not only Linda and I know you because we've already interacted with you, but our guest will also know you and we'll be able to interact with you better along the way. And as to that guest, I am so excited to be able to say that we are joined today by Scott Konrad, who is a senior vice president and not-for-profit practice leader at the international brokerage of Hub International. Scott is not only a wonderful guy, but he is a true expert on nonprofit insurance in every sense of that word, and a wonderful resource for any nonprofit. Scott, welcome to this webinar. I am really excited to ask you questions and also to hear questions from others.
And I'm thrilled to be your guinea pig.
That's exactly right. So, Scott, you know, I've shared with you a couple of questions that I had seen come across when I asked some of our current and former clients and support organizations, you know, if you had the opportunity to bend the ear of a true insurance expert in the nonprofit area, what would you ask them? And I've shared you a couple of those, but I also want to make sure that people like Jennifer and Portia and Nefertiti know that this is a session that you should want to participate in. So as Scott is talking about things, if he uses a buzzword that you don't know, raise your hand so that he knows to make greater clarification. Take yourself off mute and actually interact with Scott, because he is not going to be a potted plant, and we don't want you to be potted plants either.
No, this is a small group. I mean, I'd love to keep this as interactive as we can make it. And I'll try and speak in plain English if I can. So.
And Scott is really good at doing that. So, and if you don't want to interrupt his train of thought, but you'd like him to get around to something, in that case, don't hesitate to put something in the chat, because I'll monitor that, and Linda will also monitor that. And that way we make sure that if you have questions, we at least have preserved them so that Scott or Linda or I can follow up at some later point. Now, Great. With all that as way too much language, Scott, the first question that I wanted to ask is one that sometimes comes up when people think about talking to their insurance broker. And that's that issue of, you know, on the one hand, they understand that it's essential to have insurance and they know that they don't know that much. But on the other hand, they're worried that, well, I'm going to talk to some guy or some woman who's going to make money by telling me that I should get insurance.
Oh, you're going right to the heart of it here. I mean, come on.
So how do you deal with that dynamic, and how should our nonprofits deal with that dynamic when they think about their insurance broker as a potential resource?
Well, I guess for starters, I won't apologize for being in a for-profit business as opposed to a nonprofit. I spent my life working with charitable organizations of all shapes and sizes. I actually spent some time in the nonprofit sector myself. I think you know, Ted, working for the denominational insurance arm of the Episcopal Church, which itself was a nonprofit organization. But you know, all kidding aside about for-profit. You know, I think the key, one of the things that seems to mystify everybody is how our business works. You know, insurance brokers do get paid. I mean,
whoops. Did I accidentally
muted yourself?
I accidentally muted you.
Oh.
You
Try again, Scott.
Nope, he's still muted.
I was saying my wife mutes me all the time.
A great future if we could just get that in everyday activities.
Oh, what a great idea. Anyway, all kidding aside about you know, for-profit and nonprofit. I mean, any service provider that's doing good work deserves to be rewarded for the value that they bring. I think the you know, the issue in our sector is that there's this great mystery around how it works. Most buyers, and I've worked with folks from fledgling startup nonprofits to household name global organizations, and even in the big guys, there's so much mystery. They haven't a clue, how their broker is paid, how much they're paid, from what sources, any of that kind of stuff. So I think, for starters, transparency is always a great idea. And I've tried to unravel all this, years ago, after having so many conversations with folks who were clueless about this whole issue of broker compensation. Broker compensation. I wrote a white paper on LinkedIn, and it's up on my profile. It's downloadable. I think I called it something like, "Is your corporate insurance advisor earning its keep?" And what I tried to do was unravel all this mystery. So most insurance intermediaries are compensated by commission. That's the sort of the time-honored mechanism in our business. So the commission that the broker receives, that brokerage firm receives, is a percentage of the premium. And it varies by line of business. For something like a general liability policy or property policy or auto policy or directors and officers liability, it could be 15% of the premium. For workers' comp, it's typically something less. For workers' comp, it tends to vary according to the premium size. The larger the premium, the smaller the percentage of commission. But I think the key is that any buyer should not be bashful about asking its insurance broker or agent, how much do you get paid from our portfolio, and where does that money come from? And if there's any anxiety about disclosing that, then that ought to be a red flag. With a lot of my engagements, I work on things of all different sizes, but I would say probably the majority of my clients work with me on a fee basis, and that was at my suggestion, because to me there's something kind of screwy about this commission relationship. If we're doing a great job as somebody's broker, what we should be doing is driving down their premium, reducing their cost. And if I'm on a commission arrangement, the thank you that I get for having done that great work is I get to take a haircut and receive less compensation. Something's wrong with that picture. The flip side of the coin applies in today's insurance marketplace. Those are the folks who are on the call. If you've been through renewal anytime recently, you know that it's painful out there. The market is a hard market. Insurance companies are charging more for the policies that they sell. Doesn't necessarily mean that we brokers are working a lot harder, not in a straight line relationship to premium anyway. So there's something screwy about that relationship. So I've gone to a lot of my clients. I said, look, let's get rid of this commission stuff. Let's take it out altogether. And when we go to the marketplace to negotiate their premiums, we tell the underwriters to net it out. In other words, remove it altogether. And we provide our client all the quote letters from the underwriters showing that there's zilch commission baked in. In instances where the commission is embedded and it can't be removed, like a workers' compensation policy, the rates already include some allocation for a brokerage commission. In those instances, we accept the commission, we disclose it to the client, again, providing the underwriter's quote letter, whatever evidence they need, and then we apply that as an offset toward our capped annual service fee. And the service fee is really, it's not an exact science coming up with these numbers, but it's generally a reflection of the scope and intensity of work. Is this somebody that requires a lot of loss control visits, for example, over a course of a year? Do they want to have quarterly claims meetings? What's the workload look like? And who's going to be doing the work? Are these junior level worker bees or seasoned folks? A little bit like in a law firm that you would have come from, Ted. A partner is worth more than an associate, an associate's worth more than a paralegal. So, that's kind of the mindset behind it. Just to wrap up on this thought. So transparency, I think, is key. Obviously, we all want to work with nice people. There's plenty of nice people out there, but I think any discerning nonprofit needs to go beyond just picking a nice person, and really be looking for things like an understanding of your business. These folks understand what we do. Do they understand the financial and operational and governance challenges that we face? Do they understand the cultural dynamic of the charitable sector? It's a lot different than the for-profit sector. Obviously, you look for things like technical expertise. Do folks know what they're doing? I mean, are they insurance experts? You look at things like market relationships. Does the intermediary work with a wide array of insurance companies that understand the charitable sector, like this kind of business, and have executive level relationships to be able to get things done when the going gets tough? You look for things like creativity. You look for resourcefulness, somebody who's not just an order taker, but somebody who's going to bring genuine value. Accessibility and hustle. I mean, my clients have my home number, my home mobile number, and nobody really calls on a weekend, but I don't want them to feel bashful if they've got a need. And then, obviously integrity counts for a lot. How do you measure that? I guess, talk to other folks that have worked with that broker, and ask if their heart is in the right place, and are they people who do what they said they're going to do when they said they're going to do it. They honor their commitments. That it's pretty simple stuff.
So let me unpack that a little bit. And in fact, I want to take it down to its most basic level, because you gave us some great information. One of the things was you listed a number of different kinds of insurance.
Yep.
And so I would like you to essentially, if you could just very briefly describe the standard lines of insurance that a nonprofit should be considering.
Yep.
And essentially, if they can only have a couple, what are the absolute ones that they must have?
Sure.
From a practical perspective.
The answer, obviously, it's a broad question. The answer is going to depend on the organization. You've got a collection of different types of organizations right on this call. So my guidance to any one of them is probably going to be different than from the next. But if you look at the common denominators, which I think is where you want to go with this, I would say any organization needs to have some kind of general liability insurance. So general liability insurance is protection against claims that other people, outsiders, would make against either the organization or its people because of some negligent act that resulted in bodily injury or property damage to that other party. I saw Jennifer's with a museum. So you have the public coming in to see the collection. People slip and fall, pretty everyday kind of thing, but you need protection against that. If you have a concession or a catering facility on site, for example, where somebody could get lunch, general liability is going to take care of things like food poisoning. God forbid somebody would get sick. Maybe it's a contracted arrangement where you have an outside caterer providing the services on a turnkey basis, in which case you want them to provide evidence that they've got the right kinds and amounts of insurance. So general liability insurance, again, this is safeguarding against civil liability for bodily injury, property damage, or personal injury to others. And I don't want to go too into the weeds here, but personal injury is things like libel, slander, defamation, invasion of one's right of privacy, false arrest, things of that sort. Property insurance, I'm guessing that everybody has some kind of property. For folks that are working in a virtual environment, it may just be a few things at some vacant home office right now. Everybody's working from home, but you've got computers, you've got valuable papers, you've got things like that. So there may be a property insurance component to it. Thinking in terms of auto exposure, not every nonprofit has a fleet of vehicles, but everybody has some vehicular exposure. For employees that might have occasion to rent a car when they're traveling on business, or the everyday exposure is people that are driving their personal autos for business. So I work for Hub. I don't have a company car or anything like that. I have my own car, a Mini Cooper, and I have it insured, and I put 20,000 miles, in normal times on that car per year, traipsing around on Hub's behalf. If I have an accident while I'm driving around on Hub's behalf, I'm going to look to my own insurance, to Liberty Mutual Insurance, to take care of my individual liability to that other party for any damage or injury that I would cause. But Hub, because it's my master in this servant-master relationship, could have some liability. If I create negligence, that liability can be imputed or ascribed up to Hub as my corporate master. And so the organization itself needs to have hired and non-owned auto liability insurance. I mean, I would say that's a must-have for any nonprofit. Once we get beyond those basics and some of those things, the auto, the general liability, the property, that can all be bundled together in something called a commercial package. And a package gets its name because you're packaging or bundling different types of coverage under one roof. You get a discount because you're throwing those different types of coverage together. Beyond that, I would say it's going to depend very much on the organization. I always suggest that people look at obviously directors and officers liability insurance. You've got a board of directors. Most organizations have some kind of a governing body that can be held accountable for the decisions that they make on the organization's behalf. Could be decisions having to do with investment, asset management. It could be decisions having to do with disclosures to lenders, information that's released. It could be decisions about employment issues, who gets hired, who gets fired, all those kinds of things. So a management liability policy is important. I call it management liability because directors and officers liability is one type of risk exposure, and employment practices is a related exposure. It's sort of the sister exposure, but it's different from D&O. And then the third one is fiduciary liability coverage. Anybody that has employee benefit plans or a 50 retirement plan, 403B plan is what I was thinking. I was thinking 501C, 400B. I'm getting the alphabet soup here, but those plans are all subject to ERISA, and a directors and officers liability policy. If you go through the fine print, and I obsess over fine print, the directors and officers liability policy, every one that I've ever seen, has an exclusion for claims that arise out of ERISA or its look-alike statutes, federal or state or local statutes. The idea being to shift it out of the D&O policy and into a fiduciary liability policy. So anyway, the combination, yeah, Linda.
For the purposes of this conversation, can you go ahead and since you use the acronym ERISA, can you go ahead and explain
Sure.
ERISA?
Good point. So ERISA is a federal statute. It's the Employee Retirement Income and Security Act of 1974. ERISA is what everybody knows it as. But ERISA is just one of many government laws that relate to employee benefits. So this, I've had folks say to me, religious entities, for example, who are exempt from ERISA because they have to file an informational tax return, but that's about all they have to do. They're exempt from a lot of federal statutes as religious entities. They will say to me, well, we're not subject to ERISA. Why do I need this fiduciary liability coverage? I said, well, you may be exempt from ERISA, but there may be state counterpart laws or local laws that govern these things. And I don't force feed insurance to anybody. I mean, I'm an advisor. I help them look at the risks that are on the landscape and then figure out what to do with those risks. And as I would tell you at some point during this call, insurance is only one solution. There are other things you can do, and that's your bailiwick, Ted.
Absolutely, Scott. And two questions to follow up on that. One is, so many nonprofits have been facing this double whammy as a result of the pandemic.
Oh, yeah.
On the one hand, they have costs increasing because they have personal protective equipment and workarounds and technological stuff that they've got to add on that they weren't expecting because the museum's not closed, but some of the function still happens. Sure. and or whatever. And at the same time, some organizations, not all, but some have actually seen increase in demand for services. Yep. In light of that, if they have cost pressures, what do you say to an organization that says, boy, I ought to reduce my insurance coverage, or I ought to reduce my risk management work because I'm facing these cost pressures?
Well, I think I'd be really careful. And this may sound self-serving because I'm an insurance guy, but I've been at this for 44 years now, and I've said for most of that time that you ought to think of strategy first and insurance last. I mean, insurance really ought to be the court of last resort after you've done a bunch of other risk management work. I would be very careful about jettisoning your insurance. So certainly the cornerstone key insurances. It's the agent or broker's job to create options. And so, our role is to help you optimize the right balance between the amount of protection you buy, the risk that you retain yourself or absorb on the front end through deductibles and what we call self-insured retention. Some policies have those things, and the premium you pay. So it's trying to strike that right balance. And so, one of the things that we brokers can do is create some competition. We can do some shopping for you and try and, squeeze all the fat out of the premium. You always have an option of reducing the amount of coverage that you have, or, my preference would be to insure against the catastrophic. But if you can look back over time, over the last 5 years or 10 years, and say, well, gosh, we've been paying for this directors and officers coverage for all this time. We've never had a claim, never even have a situation that could give rise to a claim. Maybe we ought to take more risk on ourselves. And if you can do that at a level that's reasonably predictable and affordable, of course. I mean, you can't have a shock loss that'll drive you to the poorhouse. But if you could take an increase from, say, a $5,000 self-insured retention to 10 or even 20 or 25, because that you run a good shop, you've got great HR policies in place, your board, respects the bylaws of the organization, it behaves prudently. I mean, all that kind of stuff. If your risk management protocols are intact, then you can afford to take on some more risk. If you do decide to pare back on the insurance, then that underscores, I think, the importance of doing the right work in terms of risk management. The two go together.
Scott, let me again probe a little bit, because great information here. When you talk about self-insurance, I think people sometimes think that means foregoing insurance as to a particular issue, and I had that rudimentary thought as well when I was practicing law, that if you're self-insuring, then you don't have any insurance as to that. It's not just that, right?
Self-insurance just means you're going to pay whatever happens yourself.
And so a deductible is a self-insurance part of an overall, in some ways, in that you're not saying necessarily forego D&O insurance. What you're saying instead is get a D&O insurance policy that your broker gets with a $25,000,
whatever the number would be.
Yeah, or whatever it is.
Yeah. The idea, I mean, I think that the takeaway here is don't get into trading dollars with your insurance company. So, my guess is that everybody on this call has a homeowner's policy. Just think of this in the simplest terms. You got a homeowner's or a renter's policy. So now you have a water leak in your house, and the deductible on your policy is $1,000. You probably paid a pretty good bit of money to have that deductible be as low as it is, $1,000. My wife and I have a $2,500 deductible because, we maintain our house. I don't know, we take care of it. We haven't had a long history of claims. Insurance is gambling in the simplest form, and I'm gambling as a homeowner that I'm not going to have any losses that are going to cause me to spend a lot of money. I've capped my out-of-pocket exposure at $2,500, but the point is, don't get into trading dollars with the insurance company. Have your broker create options. Here's what it's going to cost you with $1,000 deductible. Here's what it's going to cost with $2,500, with $5,000. And, if you've had a clean history, I mean, history tends to repeat itself, not to say you'll never have something happen, but, the likelihood is good that you're not going to have a claim. See what savings results from taking that large deductible. And, you can bank that money year over year over year. And if something happens, then you can absorb that deductible. I mean, that's.
Scott, let me probe another one, because in the chat, Nefertiti asked a great question when you were talking about D&O insurance, which was, does does the nonprofit incorporation, the fact that they're a nonprofit, and somehow limit the liabilities for directors and officers? Now, that's one that I want to hear your thoughts on.
Yeah.
But as someone who has been, has been a lawyer for 20 or 30 years, my initial reaction to that is there are laws out there that talk about limitations on liability for nonprofits.
Right.
That is no reason to forego directors and officers insurance, because there are now so many plausible exceptions to that.
There
And
you go.
even if an exception would ultimately apply, Nefertiti, what you're really worried about is the pain and anguish, the organizational pain and anguish of the potential for liability that won't be resolved for a year and a half or more in the courts. And so having a directors and officers policy allows you to recruit directors and officers and be able to say, if there is a claim and if we followed the general rules, you're not going to have to worry about this. But Scott, how would you respond to Nefertiti's question?
Well, you answered most of it. I mean, I'm not a lawyer in full disclosure, but every state has its own set of laws. So I don't think we can make a blanket statement about the existence of volunteer immunity. The immunity, such as it is for the individuals, not for the entity. So the entity itself, could still be named as a defendant, and it's going to need to be protected. Secondly, there are, to your point, Ted, always exceptions. I mean, there are generally exceptions for willful, wanton, reckless kind of conduct. People can allege whatever they want to allege. All it costs is the filing fee at the courthouse, and they can spew all kinds of stuff about you. As soon as those suit papers come in, you've got to defend yourself. You're going to be running the meter with some lawyer for some period of time until you can prove that the volunteer immunity statute applied in this instance, and you can get the people out of the soup. But in the meantime, defending a claim can be very expensive. I think one of the most important things you're buying in a management liability policy is that defense coverage. So that would be my answer, Ted.
Makes perfect sense to me. Let me go in a slightly different direction, but I think it's ultimately related, which is every one of the organizations that's on this call has at least nibbled on the outer edges of risk management.
Good.
And one question would be, does having a risk management plan as such lower your insurance rates? And I'd love to hear your answer to that question. I tend to frame it as, what are the principal claims that can happen to a nonprofit organization, and how might a risk management plan reduce the likelihood of you having costs because you catch those things before they happen? So I'd love to hear your reaction to that question.
I'd be hard pressed to provide empirical data that shows a straight line correlation between practicing prudent risk management and lowering costs. I mean, it's not quite the same thing as, in my house, I have ADT alarm services. Yes, I do get a discount from Liberty Mutual because I have the alarms. I got a certificate from ADT that shows that they exist. Liberty Mutual recognizes that my house is safer because I've got carbon monoxide detectors, I've got fire detectors, I've got motion detectors. It's central alarmed into the police and fire department. So that makes me a better risk. We're not talking about that here. I would say that insurance companies obviously are in the business to make money. Their objective is to take more money in than they have to pay out in premium. And underwriters are selective. They pick and choose which risks they want to insure. In this marketplace, which, as I've described before, is a hard marketplace. Not only are costs going up, but we're seeing certain kinds of coverage becoming much more restrictive. We're seeing the amount of insurance that you can buy being limited in some instances. Along with all that, underwriters are being even more persnickety. They put on their little white gloves, they touch something, they say, oh, it has some risk on it. No, we can't touch this one. Well, guess what? If you can prove to the marketplace, I mean, preach about this all the time, showcasing yourself in your most favorable light to the marketplace. That doesn't mean any sleight of hand or distorting the story, but if you're doing something good, if you've got a great property conservation program in place, if you've got a corporate safety program in place, if you've got an organizational auto use policy that governs, the kind of the rules of the road for people that are driving on the organization's behalf, if you're doing any of those things, or if we're talking about cyber risk, if you've got a really tight technology infrastructure, you've trained all your people on how to avoid clicking on those malicious links, you do all those good things. That story needs to be told to the marketplace, and yes, they will give you better treatment. The only issue is I can't say, oh, it's going to be 10% or it's going to be this or that. It's underwriting is subjective, but you want to make the best impression that you possibly can. So
No, Scott, thank you so much. And I don't remember, Linda, I think we said this was scheduled for a half hour. Is that right? But I know, Scott,
for an hour in my calendar for some reason.
yeah, well, what I would love to do is, if anyone needs to leave at any point, they can certainly do so.
Catch the play.
Yeah, but on the other hand, I think that I'd love to continue to ask Scott questions and make sure that if there are additional questions that y'all have, that you have a chance to ask them as well. Jennifer, do you have any questions that have come up either at the museum, or, not to put your museum on the spot, we're going to do it the same way we always do. Is there an issue that an organization like yours might face that Scott might be able to provide some guidance on?
Well, yes and no. I'm an insurance weenie, so I'm doing this. I'm doing this seminar because it's fun.
Yeah.
Have you seen a professional about this problem?
Yeah, I know. It was interesting hearing your conversation earlier about the, do we get a discount for being good risk managers, et cetera. That is actually the on-the-ground experience for people who work with fine arts risk.
We know all about fine arts. Our company is a broker to the Smithsonian and many museums.
Yeah. And I don't know if we have people left on this call besides me, but I think one of the important things for people to realize is that your broker is your intermediary between the underwriters or the company. And, so and this is something that I've had to deal with a lot with, just trying to convince my colleagues in the museum world that they ought to be talking all the time with their brokers. Yep. And that the brokers aren't going to tattle on them to the insurance companies. They're there to answer questions before the thing becomes a problem.
But actually, I would take that a step further. And every broker behaves differently. Some like to insulate the insurer from the buyer, and
I've had one of those.
Vice versa. I tend to believe that. I'm in the business of avoiding surprises.
Yeah.
Probably the most important responsibilities I have are eliminate surprises and manage expectations. And obviously, the insurance piece goes along with it as well. But in doing that, I've had just a string of situations over the years where some underwriter doesn't really understand my client's business, and try as I may, and I really do make a diligent effort to get to understand what somebody does and how they do it, how they think about risk, how they manage risk, all that kind of stuff, and showcase it to the marketplace. I really believe that there's no substitute for the buyer and the underwriter talking, getting to know each other and forming a relationship. I'll give you an illustration. I have a client that's a global NGO, international environmental type organization, household name. We did a deep dive assessment of their whole corporate risk and insurance thing probably 5 years ago at this point. The CFO asked us to look at it. He was new on the job, and he had this kind of an uneasy feeling that things didn't add up. So we did the review, and it took a couple of months to do, but we came up with a laundry list of 50 cleanup items. And I mean material gaps across the portfolio. Things that if any one of these things fell into the cracks, they had a situation that would fall into the cracks with any one of those situations, it would ruin somebody's day and more. So we became the broker. We went to the insurance company that was sitting on most of the portfolio, and we said, here guys, here's a list of 50 things that we want you to fix on this program. And the insurance company said, what do you need these things for? They're not even relevant. We said, excuse me? And we talked a little bit longer. It turned out that they thought it was a completely different kind of entity. So we said, time out. Why don't you bring your commercial lines underwriter, bring your international underwriter, bring your management liability underwriter to our client's office at such and such time on this date, and we'll have their executive team there to talk through this. So we had the CFO, the CIO, the COO, the HR executive, all the brain trust of the organization there. We played show and tell for about 2 hours. At the end of the meeting, the insurance company said, wow, we understand this account now, and we really like this account. We want to stay on this. And all those 50 things that you asked for, yeah, we're going to do them. And it didn't even move the needle on price. So, I mean, we in 1 2-hour meeting, we chased out any possibility of surprise. The insurance company felt comfortable with the risk. They didn't feel like they were going to get surprised after having, charged a premium. Oh, you're doing that? We had no idea you were doing that. And by the same token, the client isn't going to get ambushed by some claim denial on something for which they thought they had coverage all along. So
yeah, well, and that's a moderated conversation with the broker in the room about how to organize an insurance portfolio.
Yep.
What I'm thinking more about is, I have a lot of colleagues in the museum world who are afraid to talk to their broker about something that could be a risk, because they don't want to set off the underwriter and think that they have more risk than they do. And so that's where it becomes
but the broker
I've had brokers too who are really more. Go ahead.
The broker should be your confidant.
Yes.
Your
And that's what I tell people. Yeah.
And the broker is your friend. Broker's not going to go squealing to some underwriter. The broker's going to help you solve your problem. Let me turn to a little different subject: claims. You buy insurance because stuff happens. And they wouldn't have printed bumper stickers that said that if it weren't true. So, stuff happens, and you maintain insurance. And, despite the best laid risk management plan, things will still happen.
Yeah.
So just because you have claims doesn't make you a pariah, doesn't mean that your rates have to go, skyrocketing up or anything. I think the key then is to showcase it to the marketplace by saying, yes, we had these claims, but as a result of these claims, we retooled our HR policies or our corporate safety policy. We instituted an art conservation, whatever it would be. And show them that you got religion by having those claims, and that now you stand as a better risk than back when those things happened. I mean, it's turning lemons into lemonade, basically.
Oh, yeah. One sort of highly specific question. I'm assuming that the biological exclusion is, because of the pandemic, is sort of one of those things that's getting carved out of people's policies that now.
Yeah, I mean, there were bacteria and virus exclusions, situationally in different policies. I mean, we saw it a lot in general liability policies. I would say now, in the wake of the pandemic, it was probably at mid-year last year that underwriters woke up and smelled the coffee, and now they're all putting communicable disease exclusions in policies. I've got, large cultural institution clients, and, we'd love to be able to get rid of it, but it's not there. There may be some specialty solutions. I mean, I've seen some things out of London market, where they tend to be pretty opportunistic, and when there's a need, the market finds a way to solve that need. But it's pretty damn expensive, unfortunately.
Well, yeah, and that's one of those. It speaks to one of those situations that. I'm always working on in whatever institution I'm in, which is you can basically try to defray risk contractually, but in the end, somebody's going to try to follow the money.
Yes.
So if the person, if the entity you're trying to defray risk upon is a stone and there's no blood there, and they don't have the funds to back up, they will look at you and say, you're a museum, you're full of priceless artifacts, you must be rich, and they will go after you. And I think that's what I
true, but
really most, yeah, like when, I can't remember who, Nefertiti brought that up, was like, oh no, because if you are a certain type of entity, people are going to assume that you have the money and they're going to follow the money. So
Yeah.
you can try to defray risk contractually with people you're partnered with all you want, but if they don't have the insurance and you don't have the insurance, they can come after you.
yeah,
Scott, if I could interrupt, I want to make sure that Jennifer has a chance to hear your answer to a question that I really, really think is pertinent, not only to a museum like hers, but virtually any organization, which is, Jennifer, you're in Memphis, right?
Mhm.
Your organization, your museum has been dealing with reopening issues and how to treat employees and so on. And Scott, every organization that's in our group, every organization that in the United States is facing that issue of how do we approach going back to work? What are the policies? What are the best practices? Tennessee, I know that the city of Memphis has some guidance
Shelby County.
that Shelby County does, but
Mhm.
at the statewide level, it's not that good. Scott, if you were going to say, if there are any resources that you would suggest to someone to feed into that process of identifying best practices and conforming to best practices when they're thinking about reopening and so on, is there anything out there?
well, I mean, obviously there are any number of considerations. I mean, things ranging from workplace health and safety issues to public and client liability issues, regulatory compliance issues. I'd be the first to tell you, I'm not an expert on all the risk mitigation techniques. I guess without sounding self-serving, it's one of the beauties of working in a company like mine is that we've got a pretty big toolbox and talent bench. So, one of the more important skills I need to know is which buttons to push on the phone to get the right help to somebody's table. But I think it's safe to say that if an organization is following best practice from places like CDC or OSHA or state and local government, if you're following those things and you can document that you're following it,
Yeah.
then if something happens, it should be pretty defensible. I mean, Ted, you're a lawyer, who would understand liability defense. I got to believe, if you followed the guidance and again can document it, you ought to be in good shape. Where people get in a problem is where the state of the art, the expectations on the part of government and everybody else is at a certain level, and you just put your head in the sand and disregarded it, and then something happens. You're going to be held accountable.
Yeah.
Yeah. But I would say, in terms of resources, without doing a pitch for Hub, we actually have a ton of really good information on our website. If you go to just Hub International, all one word, hubinternational.com, on the landing page, at the very top of the page, there's a Coronavirus Resource Center link. And if you go in there, it's just a treasure trove of stuff on, lately we've been doing a lot of stuff, webinars and published content on vaccines in the workplace. We've got a lot of people that are saying, should we mandate that our employees all be vaccinated before they can come back? That's got some
risky, but yeah.
Got some
I wish
issues
we could, but yes, it's risky.
So
Yeah.
there's that issue. There's issues of employee relations and benefits. There's compliance and regulatory considerations. There's operating resilience issues. For those that are like us, we're going to continue working remotely for a long time yet. So how do you telecommute safely? The boundaries of work and home get kind of fuzzy. If somebody says, well, they were injured on the job, but it happened at home, how do you deal with that? So anyway, go to the site because there's a ton of good information. It's all free. It's not gated access. You don't have to put an email in, but there might be something that's useful.
Well, and to that point, for those who watch this later, Scott's false modesty notwithstanding, he is absolutely right that the hub resources are extraordinary. I've shared them on LinkedIn before. I
Good.
shared them with our clients and customers before. They are well thought out. They are really good stuff. And so
Yeah, I say this all the time. We're not insurance peddlers. We're problem solvers. And so, yeah, insurance is one solution, but there's all kinds of other things that people can do. And, you try and help them along the learning curve. So.
Scott, another thing that I wanted to ask, because I'm sure a lot of nonprofits are worried about this, is have you seen any trends that in the marketplace in terms of premiums or in terms of coverages that you'd be able to talk about that nonprofits should be aware of?
There's well, I've alluded to it already. I mean, the trend I would say is rate increases, and this has been consecutive rate increases for 24 quarters or something like that. I don't know, 24 quarters, but for a couple of years anyway, every quarter brings higher rates. That's part of it. We're seeing new exclusions being strapped in. We talked about the communicable disease exclusion. A couple of years ago, we saw the onset of cyber exclusions in different liability policies. For folks that are working with vulnerable people, I mean, a museum as an example, I've got to believe you have a youth education component to what you do. So one of the risks you need to be concerned about is abuse and molestation. It doesn't mean that anybody's actually doing any bad stuff, but all it takes is for somebody to say that something happened.
We just all went through the training.
There you go. There you go.
Yeah.
So,
And it's documented and we have certificates.
and that's
We do nothing but process at museums. That's what we do, is process and documentation.
Yeah.
So,
But if you buy that coverage, one of the things you may see, if you haven't already, is that the availability of that coverage is going to become challenging. Once upon a time, you could buy it in your primary insurance policy, in your general liability policy. And then if you bought catastrophe protection above that as a safety net, umbrella or excess insurance, generally they continued your coverage, your abuse and molestation coverage right up to the full umbrella limit. Now they're cutting back on.
they've sublimited that.
Yeah, they are. They are. So, and some companies worse than others. I have some stuff here, Ted, if you want me to. I don't know, I'm trying to be sensitive to time, but I do have some data that just came out over the weekend from the Council of Insurance Agents and Brokers. Yeah. If I can share my screen, I'll put it up here.
Yeah, please do.
Let me give this a shot, and I just want to make it a little bigger for everybody to see. Hang on. There we go. So, as you can see, over the long haul, the insurance market is cyclical. There's just no getting around it. I've been at this long enough to have been through, I think, 4 different market cycles of different severity. The industry just doesn't seem to learn from its past mistakes. So it is cyclical. I would just accept that as a fact of life. But here you can see that since 2017, rates have been creeping up and up and up. When we drill down and look at what does that really mean, well, it does vary to some extent by the size of the account. This is data from the Council of Insurance Agents and Brokers. So it's a trade association that represents the interest of our industry. And it's data that's based on surveys, responses to surveys that CIAB has sent out to all its members. So it's everybody from the largest global brokerage behemoths down to local insurance agents. And they collect that data every quarter, and then they slice and dice it. So CIAB defines a small account as an account that generates less than $25,000 in brokerage remuneration. Again, this is why it's important to know what your broker gets paid. A medium-sized account is $25,000 to $100,000. Large account is over $100,000. If you just use 10% as a good average commission level, a small account would be somebody that's paying $250,000 in premiums or more. A medium account anywhere from $250,000 to $1 million, and large account would be over $1 million. Anyway, you can see that it's the large accounts that are getting hit the hardest. Smaller accounts are having an easier time of it. But then so this is the data from fourth quarter. You see that the average increase, this is for all different types of accounts, all lines of business, all areas of the country, is 10.7%. When we look at the line of business, you asked at the very beginning of the call about core insurances that people need to consider. These are sort of the foundational insurances. So auto, workers' comp, which is for occupational injuries, property, general liability, and umbrella. the umbrella is killing people. That's 21.3%. As an average increase. Sorry, I got ahead of myself. 21.3% as the average increase. And
Scott,
yeah,
is that umbrella because there's just so much that can kind of float under it, and they'd rather just look at individual specific risks?
it's hard to say what's driving the umbrella market. I mean, you hear underwriters that are crying about social inflation, and I believe it is for real. Social inflation is, the notion of just catastrophic verdicts. We see more and more big verdicts all the time. We were talking a minute ago about abuse and molestation. You got 17 or more states now that have expanded their statutes to allow victims a window of time within which to bring their claims for abuse and molestation, no matter how long ago the bad deed happened. That's causing insurance companies to run scared. It used to be, though, that umbrella pricing was always a function of the pricing for the policies underneath.
Right.
Now it's kind of like the wild, wild west. I mean, it's just, there's no rhyme or reason to it. I've seen folks that, they're just, it's an opportunistic and I dare say predatory marketplace. Underwriters will get whatever they can get. So when we take it a step further, and now we look at some other specialty insurances, things like cyber insurance or directors and officers liability, employment practices liability, you can see that those segments have been hit pretty hard too. In the fourth quarter of last year, 14.7% average increase for D&O. Some folks saw as high as 32%. I've got a client that last year, it's a household name cultural organization in New York. They had a salacious harassment thing going on between two musicians in this organization. It was front page of the New York Times, the New York Post, all the major media. This is just the kind of juicy stuff people love to read about. And it was eventually adjudicated. They spent high seven figures for their defense on this case. It was eventually adjudicated against them for over $1 million. Well, their directors and officers and employment practices insurer ran for the hills, non-renewed the account. It forced them out into this volatile and predatory market. We went to 30 different insurance companies to find a home for them. We did eventually, but it was a 600% premium increase. I mean, in raw dollars for an organization of this particular size, it wasn't petty cash, but they could suck it up and probably afford it for another year. But in raw percentage terms, it was awful. So, they felt the perfect storm of a horrendous claim superimposed on a very challenging market. But this is what's going on out there.
Yeah, I think that just underscores how important it is that you use insurance as your last resort.
You got it.
The good insurance is that thing when you can't manage the risk.
That's right. When you can't avoid it, you can't mitigate it. When you have to do something to shift. Yeah.
With my client that absorbed that big increase last year, we're talking about their renewal that'll occur at mid-year this year. And my guidance to them is we need to provide the insurance community, a really cogent write-up of all the things that you've done to change the way that you allow your employees to interact with one another, the training that you redoubled the training. We need to show them that you get it. And I think this time will be a different ball game. I mean, they paid that pound of flesh last year, unfortunately.
That sort of goes to the question that Ted was kind of digging at earlier, that if someone has a robust risk management process that gets to these things before they can hit to insurance,
absolutely,
while there's no way to put a number on it, it's absolutely an attribute that will be viewed favorably.
Well, if an underwriter has a stack of new accounts that he's considering for July 1st, and he's got to go through those and decide, well, I want this one, I don't want that one, who's he going to give the attention to? He's going to give his attention to somebody that he thinks can be a profitable account for them because it's an organization that has its house in order. I mean, I'm preaching to the choir here, I guess.
And that's another thing for newbies in this is making that distinction that underwriters are people.
Absolutely.
Yes.
Which is another reason that you
a
want
lot of my colleagues don't understand that. They think they're the companies.
Well, and
not human beings with fears and fallibilities or greed or whatever it is that they have.
Absolutely. I mean, if I were to get on a soapbox and lecture to the insurance buying community. The one thing I would try to disabuse them of is the notion that insurance is a commodity. I think TV, advertisements have cheapened the whole subject, because there's this notion of, oh, you just go online and with one click, a mouse click, you get all these quotes in front of you and you just go for the cheap one. That lowest unit cost is the measure of value. It is not. It's a professional service. And so, I think if people recognize that and they invest the time to get to know their underwriting partners, you get some money in the bank with somebody, and really forge those relationships. Then when the going gets tough in a market like this, maybe you can call in some favors and get some things done. If you're flitting around from year to year to year, always tire kicking, looking for the cheapest, it's going to bite you.
Scott, let me follow up on something.
All right, Linda.
Sorry.
Linda had her finger up. I'll go with Linda.
Go ahead.
We're almost out of time, but I wanted to go to that because I come from the world where I did know my underwriters because I was big.
Yeah, I know.
We did do the sit down at the table and everything. But in this conversation, we have a lot of very, very small nonprofits that are teeny tiny. What advice would you give to some of the really little guys who might hear this conversation as being beyond where they see themselves?
Yeah, I mean, I don't think that the concept is impractical even for small folks. I mean, I have done this with fledgling startups, organizations that are just getting their sea legs. And, I want the underwriter to hear about their business plan and the way that they're going to be setting things up. And again, if you don't talk to the underwriter directly, there's certainly no substitute for having the broker put together, a really thorough submission. I mean, filling out a bunch of applications, doing mail order insurance, I think has very little value. The broker ought to be something more than an order taker. Should be a counselor and an advocate. So it's the broker's job to, boil all those good things that you're doing into a cogent submission. You ought to see whatever they're sending out before they go off to the marketplace. And again, it's the broker's job to create options. I don't think any of this is beyond anybody on the call. Really.
Scott,
I love that summary.
Yes, this has been fantastic. And
I hope.
And we've taped it. We're going to have it we're going to have it available to others who haven't been able to join. One thing I was wondering is if either someone on the call or someone watching this later wanted to reach back to you, how
Sure.
would they find you?
Oh gosh, I should have had a thing with my contact information. It's real simple. Scott, SCOTT .Konrad, but with a K. So it's KONRAD, German spelling, at hubinternational.com. Best place to start is just simple email. With your contact information, then I can close the loop and take it from there. Again, I'm not an insurance peddler. One of the things that I'm telling my colleagues all the time is chill out. People do things for their reasons and on their timetable, not ours. So relax. In the fullness of time. Anyway.
Scott, thank you so much.
We never did talk about cyber, but that's maybe another chapter.
Exactly. We'll have you back to talk.
Another bundle.
Yeah, we'll have you back to talk specifically about cyber. How about that?
Sounds good.
All right. Well,
the opportunity. Appreciate everybody's questions and nice to meet you all.
thank you
Good
all.
luck with your new renewals. Take care.
Bye-bye now.
Take care,
Bye-bye.
Scott.
Bye. See you, Linda.